These funding mechanics provide strong pitches and provide them to grow on a larger and a global level. These leverage institutional and plus the most important thing is government support. So where the risk is taking, the life is celebrated, and where the risk is not taking, the business does not grow. I will be ending this session with these words. Thank you and have a nice day. Government is helping the new startups to initiate the new launching of softwares and the platform that are required in a new business. For example, the biggest challenge that company faces to grow is their own app development. For example, if you are ordering something on Zomato and you are ordering something on Swiggy, the first thing that will interact with the company is the application that they have built. The application infrastructure is set up by the artificial intelligence. For example, you are hungry right now and past 3-4 weeks ago you have ordered samosa. And as of now, Zomato knows your location and they know that it is raining right now. You just get a notification pop-up like it is raining right now, you should order samosa. Your mind will just click and you will order samosa. That's how AI works. Okay. So these startups are using AI very proficiently to provide your own meeting hunger needs. Okay. So that's how AI is working in the new startups. Now let me tell you some case studies. You already are aware about these case studies. The first is Flipkart. Flipkart raised seed funding from Escal Partners and later they built Tiger Global and SoftBank. Second is Ola. Ola received angel investment from Snapdeal founder and later venture capital funding from Sequoia and SoftBank. Paytm started with seed support, scaled through massive venture capital funding. Okay. The best practices for pitching and attractive funding. How you can give a funding. Being an angel investor, how I will provide you that I can provide you funding. The first is prepare a strong business plan. The second one is demonstrate problem solving scalability. The third one is showcase traction through customer revenues and their past performances. Okay. And also the most important thing is credibility. There must be a good credibility, then only you will be a good angel investor. Now you know the word due diligence. Due diligence means the required necessary action that are required before being an angel investor or investing in a new company. Due diligence is the word that is basically used in the companies to perform a task which requires some legal frameworks. That will be already told you in the company law when you will be reading this year. Due diligence, the word due diligence. Okay. So due diligence involves verifying the startup legal, financial and technical structure, market details before investment. These venture capital require balance sheet, intellectual property, founder and credibility of the past business. Okay. Now let me tell you how after being a successful business investor, how they exit out of a business. Basically the angel investors exit out of a business. So first of all, what they provide? IPO. I think everyone knows about IPO. What is IPO? IPO is initial public offer. That is basically in the Gazette of India, in the official Gazette of India, that is in the newspaper or in the online stock exchange. I think most people know about the IPO, Zomato IPO, and many companies also share the IPOs. The second is acquisition and merger. After IPO, what it comes? Acquisition and merger. The third is secondary sales of share. After IPO, that is the primary sale of share. At the time of IPO, what is it? It is the primary sale of share. After this, second stage is acquisition and merger. And after primary sale of share, what will be done? Secondary sale of shares through off-market openings. Okay. The fourth is founder buyback. Founder buy. The founder also injects their capital into the business. Now what they do? They just withdraw their money and they provide just the amount that is adequate to run that business and to remain the owner of that. So today we're gonna start a lecture or on angel investments and venture capital. So there are two words. The first one is angel investments or angel investors to be precise, and second one is venture capital. So first of all, let me tell you, these two words are belonging to one thing, that is startup funding. Whenever any venture or a business is set up, so I think you all know what is a business and how a business is set up. What the primary objective of business? To start a business, first of all, what we require? We require capital. Very good. So once we require capital, that capital needs to be flowed into the system or to the business through various mediums, and these mediums can be different, which are basically equity and debt. There are two ways to raise a capital, either equity or debt or through own funding. So first of all, when we are having a funding, raising the financial resources require the scaling in the new business. The source of fund can range from personal, we can have personal sources, like for example, if I am having some funds, for example, I am having 100 rupees, then it will be my personal funds. Now we can have savings. Savings can be of two types, past savings and the savings that we are doing from our current income. Okay. The second one that is important is government. Now government has given various initiatives like Startup India initiative and various other initiatives through which we can also raise fund. MSME, like micro, small, medium enterprises, also raise fund through this way only. Okay. So we can ask for friends to help out, like for partnerships. You have had partnerships. You can ask your friends to give some funds and start a new business. For example, if you are starting a food truck business right now, so as of now, if you are starting a food truck business, you can ask your friend to give some of the amount, like 1-2 lakh rupees, and you can give the share out of his profit. Okay. So these are the startup funding that required through the capital. Now when we talk about these things, we know this is on a smaller level. If you are starting a smaller business, these require friend, family, people, your own savings. But on a larger scale, the companies, the startup, the venture require a large amount of capital that are in billions and trillions of amount. So when you require these amounts in billions and trillions, you cannot ask your family and you cannot ask your friends to give this amount. Can your friend give an amount of 3 lakh rupees in one day? They cannot give you 3 lakh rupees if you ask. And think about 300 and 500 crore rupees of arrangement within 3 to 4 months. So that is next to impossible. For this, we have initiated new schemes of business, that is angel investments. Now, when you talk about angel investment, the first thing you hear in mind is angel. What is an angel? Angel is someone who can make a miracle. So a person who can make a miracle definitely has a lot of money with him. So when you talk about angel investments are done by those people who are having a sufficient amount to fund a growing or an starting business, a business that is ready to be started. These are individual peoples. Basically, the angel investors are the individual people who inject the money in the new business to give them a new boost. Let me give you some example of these angel investors. These angel investors are Kunal Shah. Kunal Shah is the CEO of CRED. So as of now, Kunal Shah has invested much of the money in money control, in various stock market companies, in the new leading companies. So angel investors. The second example, let me give you Vijay Shekhar Sharma. I think you have heard about Vijay Shekhar Sharma. Can anyone tell me about who is Vijay Shekhar Sharma? He is CEO of which company? Paytm. So Paytm, the CEO of Paytm is Vijay Shekhar Sharma. He has also invested in various companies which are growing right now. He is also an angel investor. The third name that I am going to give you is Binny Bansal. Have you heard the name Binny Bansal and Bansal brothers? You know The CEO of which company? Vinny Bansal. Vinny Bansal is CEO of Flipkart. He has taken over Snapdeal 4-5 years back, but as of now, the Snapdeal business has gone into losses. So he has also angel invested into Snapdeal, but it has gone wasted. So the concept of angel investment, let me tell you, these angel investors are the high net worth individuals who invest the personal fundings into the startups. Their own personal funding is invested into the startups. Okay. If the business shows profitability, these angel investors are giving smaller amounts when compared to the venture capital. The venture capitalists are the large amount investors. These are the venture fundings. Let me give you some examples of venture fundings as well. So let me differentiate the basic difference between the angel investments and the venture investment is that the angel investment is give their own personal assets or their own personal capital into the business for starting or growing a business, while comparison with the venture capital provides their whole capital, a large amount of capital to flow into the business. Okay, so the angel investment withdraws after a time. For example, let me give you an example. If one angel investor is investing in XYZ business, he'll just be in the business for a while, but after that he'll take out some of the profit out of that investment and he'll go away. But while compared to the venture capitalists, these venture capitalists stay in the business for their capital and they also participate in the profit sharing as well. Okay, so I have given you example of angel investors. Can you repeat with me? The first angel investor was Kunal Shah. He is CEO of CRED. The second is Vijay Shekhar Sharma. He is CEO of Paytm. The third one is Vinny Bansal. He is CEO of Flipkart. These are the large amount of angel investors who is having a large amount of capital in their hands and they are capable enough to inject their capital into a growing business or a new startup. Let me give you some example of venture capitalists now. So these are two different things. Venture capitalists are the firms. They are not an individual. Who are the venture capitals? They are the firms. Venture capital are the firms while the angel investors are an individual. So venture capital firms in India are, the first is India Quotient. The India Quotient venture capitalist firm was invented in 2012 and it has invented in lending card as well as share chat. The second venture capitalist firm is Your Nest. Your Nest, you can see it through Google as well. Your Nest Capital. It has invested in Unifor and Migrate. Okay, the third and largest out of these is 314 Capital. Have you heard the name of Licious? Licious is a startup which usually deals in raw chicken as well as eggs and poultry items. Licious. Okay, so 314 Capital has invested in Licious as well as Better Place. And the last one is Benny Next, that has invested in Oprah and Shadow Fox. These are the venture capital firms that provide funding to the growing or the starting business. So first I have given you an example of angel investors. These are the individual who out of their own personal profits own personal capital they share into a growing business, while the venture capitalist firms are actually the firms which give their capital to the new starting business and they also require a profit sharing out of it. Is that clear? Any doubt till now? I think no doubt till now. So let me give you the concept of venture capital now. Venture capital funding involves professional investment firms that are injected into the high potential startups. Venture capitalists expect high returns. Now, when I was talking about the angel investments, they are not expecting high returns. They are just expecting nominal returns as they have to withdraw. Like for example, let me give you an example. The angel investments are basically those tires in the side of a bicycle that are at the starting. Once you are learning to ride a bicycle, have you ever ridden a bicycle without falling? You will have to fall while you are learning to ride a bicycle. You will have to fall. You cannot start the bicycle by without falling. You cannot learn it. So while you are learning a new bicycle, generally new tires, small tires in the side of bicycle are fitted. Okay, so these are the angel investors who are giving you a time period so that your business can run and carry forward. But when it comes to the venture capitals, the venture capital will stay in your business and they'll also stay in the capital sharing of your business, and they'll also be the shareholders of your business. That is the basic difference. Now, I have given you the definition of angel investments. The angel investments are usually the high net worth individual who invest in their personal funding into startup for a certain period of time only. While the venture capitals are the firms who invest their into the high potential startups, and these venture capitalists also have equity ownership in their business. Okay, these are also responsible in the management and the decision making of the company. I am talking about venture capitalists. Now let me tell you the stages of startup funding. So the first stage of startup funding is ideation stage. What do you mean by ideation stage? The ideation stage is the stage in their personal investment, the personal capital, how to raise the capital. That is the main question. Once you are starting about a business, it's the first thing comes to your mind, how to raise the capital. After thinking about which business you have to do, the second thing you think about is how to raise the capital. So the first point is ideation stage. Second is seed stage. Seed stage is that stage in which the business into the incubation stage. Have you heard about incubation centers? Incubation centers is also there in IIMT, our college. Incubation center is center in which new business are given the way to protect the external environment of their competitors. You have also studied the business environment, ma'am has taught you. So there are two type of environment, internal as well as external environment. So this incubation stage protects the business out of the external environment or the external competitors of the business. The third is early stage, that is also known as AB stage. In this, we have to fund startups and scale the operations. The most important thing in the third stage, that is early stage, is to scale your operations. For example, when in the incubation stage, there are small units that you have to produce or the small targets that you have to achieve at the time of incubation, because you are protecting your new business and you are not taking the risk. But now while increasing the operation, you can increase your cost margin as well as profit margin. So that is the third stage. The fourth stage is the growth stage, in which you have to provide the institutional funding and expand your business on a global level or at least on the national level. Now once you have raised your business in the operations, for example, earlier you were producing 100 units, now you have produced 1000 units. Now if you are producing 1000 units, the first thing you have to do is your advertisement, a good advertisement, as well as increase your business scale. This scale can be on the national level as well as global level. Okay, and the third is when these angel investors go out of the business is the exit stage. After making these business on the global level, they exit. Who exit? Only angel investors exit. Venture capitals stays and they are the management and they also share in the equity. So at the exit stage, these investors cash out through IPO, mergers and acquisitions. Okay. So I think you have understood the difference between the angel investors and the venture capitalists. The angel investors are individuals while the venture capitalists are the firms. The angel investors only stays through a certain period of time in the business, while the venture capitalist always stays and are the equity sharer of the company. Okay.